Hi everybody, Alex Deployer from Expert Forex, and in today's video I want to chat about some basic Forex trading concepts. And the reason for that is that I recently had quite a big loss transaction, and it was because I ignored some basic Forex trading concepts. And you always need to go back to your trading concepts. If you've made a loss, try and find out why that loss has occurred. And I realized what a basic error I had made. So let's have a look at what happened. Essentially, I made that loss in the last few days. The Canadian big loss there. There's the chart. I'm not going to go into that one in too much detail, but let's start looking at some basic market concepts for Forex trading. Now, the first thing on your screen, you actually see a model, and this is a very basic model, one that I've used over the years, because although it's pretty simple, it is a representation of all the movements in the market, because you've got an uptrend here, you've got a sideways market here, and you've got a downwards sloping market there. So it's a good model that I always use to evaluate what's going on in my trading concepts. So essentially, when the price is making higher highs like there, higher high and higher lows, higher highs, higher lows, it is in an upward trend and it is trending. So that's a trending market. When it's trading between highs and lows like it is there, actually there, then it is in a sideways market, trading sideways. And when it's making lower highs and lower lows, it is in a downward trending market. Now that will be very basic to a lot of Forex traders, but there are certain Forex trading techniques that it is very important for you to understand this model, because certain techniques are sideways techniques, especially the momentum related techniques, and then other techniques are trending techniques, breakout techniques. So let's just move on to the next slide. Now this all looks very drab and all that, but so what I've done is I've put a bit of color into that, and I've said, okay, let's have a look at what in fact is the situation. So here, this is an uptrend because it's making higher highs, and then it starts going back. Now, because it's trading between a recent high and a recent low, that is in fact a sideways market. So you've got a sideways market. The minute it makes a new high, you've got a trending upward market. Then the same thing, now it's trading between a recent high and a recent low, and then it makes a new high, and that is the trending part. So we've actually only got that part and that part as trending markets. We don't know what happened before, but we'll assume that's a trending market. Now the price is trading between a recent high and a recent low. Yeah, so it's a sideways market. Sideways market. Even there, it's still between the recent high and the recent low. And only there that has become a downwards trending market. But only for a short while, because as it does a retracement, it is now between a previous high and a previous low, recent previous high and low, and it is now in a sideways market. And only when it starts making lower lows does it become a downward market. Very important for you to understand the concepts that happen here. They are pretty simple, but a lot of people would argue, for instance, oh no, this trend actually started over here. It's debatable, all debatable. All right, so let's move on and have a look now. Okay, so let's look at this slide. Now, there are two types of traders. There are with a trend traders and there are bounce traders. Now, bounce traders are ones that look for bounces in the market like there, and they would then trade against the trend and trade the bounce trade. And then with the trend traders will look for a trend like this, and when the trend's confirmed, they would also they would buy into that, for instance, that type of trade. Now, one of the things I want to show you is that, let's say we had a bounce trader, and the bounce trader traded that bounce for a sell and traded it downwards. Now, that trader would put their stop just above that line, because that's the turning point in the market. So they'll put their stop there, and because they're in a sell, their stop will be a buy order. So whatever transaction you enter with, the opposite happens when you're coming out. So if you're selling, you're going to be buying there. So that person would place their buy order around about there. Now, the trend trader will say, okay, the trend will continue when the price starts making a new high, and they will put a buy order there too. So you have a situation where the market starts hitting a whole lot of buy orders at the same time. And what happens when that happens? The price just shoots up. And the same thing here. Those are locations where both with the trend traders and the momentum traders have the same kind of transactions in place. And that is why you get these long candles or shootouts, because you've got a doubling up of orders, the buys from the sideways traders and the buys from the trend traders. And you have to know where these things happen. Same thing happens on the way down. The stop for the sideways trader will be there, and the sell for the the stop for the sideways trader would be a sell, and the sell for the with the trend trader would be there, and you get a concentration of sells, and that's what rockets the price down and creates like long candles and things like that. But very important for you to take this model and analyze it, and then superimpose it on the market and say, these are areas where there are a lot of buys. These are the areas where there'll be a lot of sells. You need to know those kind of things when trading. Okay, so now we're looking at a trend trader, because there are different kind of traders. There are trend traders, momentum traders, all kinds of other things. But let's have a look at the trend trader. The trend trader starts here, and clearly that's a trend. And the trend trader will regard this price movement as a trend, still a trend, an upward trending market, because the price has not made a lower low. So until the price makes a lower low, this is an upward trend. So up it goes. It hasn't made a lower low. It hasn't made a lower low. And it hasn't made a low low. And there's the first time it makes a lower low compared to its recent price movement. So only then does the market turn into a sell phase for the trend trader. Now, so there's a whole philosophy that the trend trader will regard all of this movement as a buy zone, and that will remain a sell zone until the price makes a new high. Very important to understand these concepts, because this is the way people trade, and the fact that you have different perspectives in the market, that's what makes the price go up and down the whole time, because different people have got different perspectives in the market. Now, here's a sideways trader. So the sideways trader would say, oh, there's a trending market, I'm going to stay out of that market completely. And then when it retraces, it's not sure if it's really retracing or not, but if it goes a little bit longer, the sideways market trader will say, okay, this is starting to become a buy zone, because I'm a sideways trader and I believe that the price will bounce from here. So that becomes a buy zone. Then when the price gets up here somewhere, and it's in line with the previous high, the sideways trader's mentality is, oh, this will be a bouncing point, and therefore this area here will be a sell zone. So you've got to get your head around that. That's quite important, because there are different perspectives in the market. And the trick is to find places where all the perspectives are the same. And we'll get to that at a later video. So the sideways trader, oh, no, it's starting to trend. I'm getting out of the market. still unsure. All right, this becomes a buy zone again, that becomes a sell zone. Oops, it's starting to trend. I'm getting out of the market. This becomes a buy zone here, then that becomes a sell zone, that becomes a buy zone, and that becomes an area to get out of the market because it's trending. You don't want to trade a sideways market. Trader does not trade in a trending market. So it's trending. That now becomes a sell zone because previous support becomes resistance, and that would be in a sell mode. But because it's making a new low, the trader gets out of the market. So can you see how different types of traders see the market? The same movement. And again, as I say, this model is pretty good from a to do these kind of perspectives on. Here's a channel trader. Now, a channel trader looks for 3 or 4 bounces on a channel. So here's a channel, 1, 2, 3, 4. There's the 4th bounce. The channel trader would buy that one, and then there's a bounce there, but that would be an against. This is what channel traders call an against the leg trend trade. Possibly wouldn't trade that particular one. Then this now becomes a sell bounce because there's 1, 2, 3. This is the 4th bounce of a channel. So the channel trader would trade that one down to this level and then buy that one there. Now what happens here is this is what is called a failed swing in terms of channel trading, because it hasn't reached the other side of the channel, and the channel trader would then sell that particular leg. Also, when the leg comes to there, you've actually got a channel here, 1, 2, 3, 4, and that's leg 5 in the direction of the trend, and the channel trader would sell there. So you need to know how different kind of traders will trade their these kind of movements. Now here's a momentum trader or RSI or stochastic kind of trader, and this trader would get very strong signals at that point. The price would become overbought, and it would get strong signals, and that's why that's a big circle. Then it will get weakish signals when the price gets oversold. So a weakish or even no signal when the price gets oversold. So the problem with momentum traders is that they don't trade well in trending markets, and you'll get stronger against the trend signals than you'll get with the trend. But the minute the market starts going sideways, strong signal there, strong signal there, strong signal there, strong signal there, weakish signal there, you'll start getting a strong signal there, but that's an against the trend trade, so that's a false signal, and then a weak one with a trend. So you're less likely to trade with the trend and more likely to trade against the trend if you are a momentum trader. So momentum traders want to trade in sideways markets. They don't want to trade in trending markets. This is a very simple model, and it does not necessarily represent reality, but this is a moving average that I've got on here. A moving average basically smooths the price movement. So when the price is above the moving average, you'd buy. When it goes below it, you'd sell, and above you'd buy, and below you'd sell, and above you'd buy, and so on. So that's the way the moving average trader would trade the system, and it looks impressive, but unfortunately in reality there's a lot of whipsawing that occurs that takes away a lot of the advantage of moving averages. But again, also, although the entry might be here, the entry, in fact, the price level might be there, and the entry looks like it's there, but it's there, so you've actually made a loss on that particular leg. It's a very deceiving type of trading methodology. Can make money from it. A lot of traders don't use it for entries; they use it for exits. So let's say they've traded that bounce there, and they will then stay in the transaction until it crosses over, and that they use it for exits rather than entry. Now, as you can see, I actually traded the against the trend trade on the channel. That was a valid channel leg. The channel trading is more of a sideways market technique, or you can trade it if you're trading like that leg there. I could have traded because you're trading with the trend. I traded against the trend. So I traded a sideways method in a trending market, and I paid the price. I was unlucky. I just got spiked out. It was turning just before the stop, so a bit of an unlucky one, but that made me think of the fundamentals and how important it is not to ignore. I took a bit of a chance there, but because of this rapid price movement there, but clearly that was a bit too cheeky. Now, I hope I've given you some food for thought, and really just go back to this model. Just remember this basic model and try and look at how your trading strategy or technique fits into this particular model. This model actually explains a lot of things. It shows why the price goes and retests certain, like there's the breakout point, it retests and goes on like that. You'll see that kind of price action happening in the market a lot, where it breaks out and goes and retests. There's a whole lot of things in this model that I haven't actually shown you, but I wanted to just keep it basic. And it's important to get back to basics, especially when you've had a losing trade. And what I would suggest is go and analyze the market in terms of where you think the concentration of buy orders and sell orders are, no matter which technique is being used in the market. That will open your eyes to quite a lot of trading opportunities or danger zones, because those areas are often also danger zones, because just a little bit of a price movement can have quite a big impact in the market. So from me, Alex Deploy, cheerio.